Monetary Policy Committee to discuss the recent decision by the Monetary Policy Committee on interest rates back in August, one of our regular sessions with the Governor and his team. And I'm delighted to welcome from my left to right Professor Alan Taylor, who's an external member of the Monetary Policy Committee, Claire Lombardelli, who's the Deputy Governor and a member of the Monetary Policy Committee, Andrew Bailey, of course, the Governor of the Bank of England, and Megan Green, one of the external members of the Monetary Policy Committee. So we had an interesting decision last time. One small technical thing is that you didn't use your casting vote, Governor. You had a second round of votes. Can you just tell us why you did it that way?
Yeah, if you don't mind, I've brought the legislation along, actually. So obviously, the first vote led to 4 members preferring to cut by 25 basis points, 4 members preferring to hold the rate, and 1 member preferring to cut by 50. Now, the legislation says in the event of a tie, the chair shall have a second casting vote. Subject to that legislation, the committee shall determine its own procedure. So the question, of course, is that a tie or not? Now, 2 things I'll say on this. My view is there was a very clear distribution of preference for a cut. 5 members preferred a cut, 4 didn't. We could have determined it was a tie, and I could have used the casting vote, but I didn't for a couple of reasons. One is that I think it actually is. I thought it was quite sensible actually to have a second round of voting and say we'll have a constrained vote because, in a sense, we know where the balance of preferences is. The second thing is that I'm conscious that this obviously. By the way, the casting vote has been used in the past, but it's been used in the context. It's been used at least once when we only had 8 members of the committee, so it's possible to have an exact tie. Of course, it would also be possible to have a 3-3-3 tie, but we've never had that, I think. But I was also conscious that we're setting precedent here, and in this case, I personally was in the 5 that were preferring a cut. But let's say I'd been in the other side. Let's say I'd been one of the people preferring to hold. Had I used the casting vote, I would then have had a bit of a dilemma, because I could have used it to back up my own original vote, but then the outcome would have not necessarily really reflected the balance of the distribution of votes. Or I could have used it to achieve that, in which case I would have ended up voting both ways in the 2 votes. And so I think it was a better outcome and a clearer outcome to say, let's have a second vote.
Sounds like a sort of logic problem, doesn't it? That's partly.
That was how we got there.
I just wanted to get that procedural point out of the way, and I obviously want to come to members about their own decisions. But before we do that, there's obviously been big things happening across the Atlantic with attacks on the Federal Reserve's independence. Yeah. As the head of the Independent Bank of England, I wondered if you had any thoughts or comments to make about the impact of that, both on the global economy. This is a very serious situation. I am very concerned because the Federal Reserve is obviously, the central bank for the world's largest economy. It's leading central bank. It has built up a very strong reputation for independence and for its decision making. So this is very concerning. And let me just make a comment on why it's concerning for me, the underpinning point, because this applies to all central banks, I think. Monetary stability and financial stability, which are our 2 objectives, underpin, I think, sort of the foundations of policy. One way of putting it is that if we do those things, we enable you then to go off and take decisions, in the areas that appropriately, governments and Parliament should take decisions in, which involve things like sort of distribution issues, knowing that the foundations are sort of sound. And I think that's important. It was very strongly the view I know of the government when the bank was made independent, certainly in respect of monetary policy. And I think what we're now seeing is people saying, well, no, actually, we should be able to trade off the sort of the foundations for those other decisions, if you like. And I'm afraid I just think that is a very dangerous road to go down. I think the job of an independent central bank is to provide those foundations, to take independent decisions to do it within the remits we're given by you. With sessions like this, we're accountable to you. That's how it works. That's how it should work. And so the threats to that, I take very seriously. Okay. And have you had any conversations with your counterpart in the US?
Yes. I mean, we talk regularly. I was at the Jackson Hole conference 2 weeks ago. I'll be seeing him in Basel this weekend. So no, we talk regularly, as we do normally. I mean, we always talk regularly.
Okay. Mr. John Grady, MP.
Just to kind of explain this thing about the independence of central banks to a way that my constituents would immediately grasp. would your position be that be careful what you wish for, because if you lose the independence of central banks, ultimately you will face higher prices,
yes,
higher mortgages, and higher costs of borrowing for social housing and business? Is that in
that's
simple
correct.
terms?
Yes, yes.
Thank you.
But there are costs to it, yes.
As ever, we want to drill it back to the impact on our constituents. So, to the decision. So we've got Megan Green and Claire Lombardelli, who both of you voted to hold interest rates and not to cut. So I thought I'd come to you first, just if you want to explain why you took that position. If I start with Megan Green.
Sure, thanks. As you point out, I voted to hold bank rate in August, and this was motivated by two main things. One is I think the risk of higher inflation persistence has increased. And secondly, I think the risk of weaker demand has decreased, particularly since May when we first put out and really fleshed out these scenarios. On higher inflation persistence, household and business inflation expectations have been elevated for some time now. The bank's done a bunch of research showing that actually sensitivity to inflation increases at a lower threshold than it might have previously because we've just come through a period of high inflation. So that threshold's now around 3 to 4%. We now have our inflation forecast topping out at 4%, so at the very top of that band. Much of the news that we've seen in inflation and feeding through into our inflation forecast has been in food prices, and food prices alongside energy prices tend to be highly salient for inflation expectation setting. And so there is a risk that you could get higher household inflation expectations, which could feed through into the wage setting process. There's also a risk that you could get higher business inflation expectations feeding through into the price setting process. The decision makers panel shows that firms are much more sensitive to upside surprises inflation now than they had been a few years ago. So there's some risk there. So I think the risk of higher inflation persistence is higher. We've also seen core inflation has flattened out for the past year. Higher frequency measures of underlying services inflation have flattened out for the past year. We expect services inflation to stay at 5% through this year. So there are some signs that maybe the disinflationary process is slowing down. We've also seen that a lot of the adjustment has come from sectors that are more interest rate sensitive, so that could indicate that some of the low-hanging fruit has already been picked and the last mile might be a bit tougher. On the demand side of things, we've looked at the relationship between the labor market and activity, and it's remained intact. We expect GDP growth to pick up, underlying GDP growth particularly to pick up modestly from here, so that suggests that any kind of labor market shakeout that I had been worried about before probably won't be coming. Employment intentions are still negative, but they're less negative than they had been previously, and that's from our agents. That suggests that some of or much of the adjustment in the labor market may have already occurred. And in May, I had actually been much more worried about trade policy uncertainty and the disinflationary implications of that on the UK economy. We have a bit less uncertainty now, so that has abated as well. So I'm more worried about higher inflation persistence, less worried about lower demand than I had been, and so I saw it appropriate to vote to hold bank rate.
Okay, thank you, Ms. Green. Claire Lombardelli.
Sure, thanks. As you say, like Meg and I voted to maintain rates at 4.25%. Similarly, because of my view of the balance of risks to inflation as we see them now, I'll try not to be too repetitive on what you've already heard, but I think let me talk a bit about inflation persistence and I'll talk a bit about activity. On inflation persistence, inflation is currently at 3.8%. It was 3.6% when we voted. That's obviously too high, and I would draw out a couple of similar things to Megan. There's a question about both the headline path and about the composition. So on the path, we've now had inflation quite high for people, for costs for businesses now for a number of years, since 2021, apart from a brief period last year. It's been well above target. I think that length of time has an effect, as well as the threshold effect Megan talked about in terms of perceptions and experience. There's the other thing I would draw out is this point about the composition, which I do think matters. In particular, we've been surprised by food price inflation. It is higher than we expected it to be. We expect it to continue to rise, and actually on central estimates we have it going up to about 5.5% at the end of the year. That's obviously worrying in and of itself. Food is a necessary good. This is extremely difficult for people. It also, we know, has this salience issue. People notice it more than other price rises, and so we're very conscious that people will be sort of alert to that. It's one of the reasons why we spend quite a lot of time thinking about food inflation, why we spend a lot of time talking to supermarkets and others about what they expect. So I think there's that. Now, you have to balance that against the risk that underlying disinflation is continuing, has certainly over the last year. There is an open question for me when you look at the data about whether that is slowing at this point or not, and I think there's sort of risks there. If I turn to activity, and we spend a lot of time looking at sort of underlying activity rather than the kind of more volatile month-to-month data, but it's very clear activity is sluggish in the UK economy. That's obviously a problem for prosperity and well-being. It's also a problem for inflation. And the thing that matters when you think about inflation is what is driving that and the balance between demand and supply. And Megan's talked about some of the factors, particularly around demand, and we have to be very alive to the risks of demand deteriorating. And then I think there's a particular risk about the consumption savings mix, and maybe we'll come on to talk to that. But the other thing that I think is really important here is low activity isn't necessarily an issue of demand. It could be an issue around supply, and I think there is quite a strong case to worry about supply in the UK. We know there is this long-term challenge on productivity. You know, we've seen that over a number of years. There's also evidence that the labour market is structurally changing, and that may be having an impact on supply. You know, issues around population, demography, health issues, all of that we're sort of aware of happening, retirement. We also have a long-standing issue about private sector investment in the UK, and of course that affects supply capacity. I sort of make this point because actually if you've got more activity more constrained by supply than demand, then obviously that's putting more pressures on resources, and that has a different impact on inflation. So I think it's slightly more complicated than just saying because you've got low activity you must necessarily have a problem around demand. I think we have to think quite carefully about the balance between the two. So sort of taking all that together, I judge that maintaining a slightly higher level of restriction would put more downward pressure on inflation.
Because it's interesting, I'll come to the Governor in a moment, because Governor, you've talked about the risk that disinflation momentum could slow as well. But before I do that, I think because Professor Taylor, you voted for a 50 basis points cut, and so therefore you ended up shifting your vote. So can you explain the rationale and why you voted the way you did in the end?
Yes, I voted to cut by 50 basis points. And I think this is in the context of a view that, you know, formed in the last 6 months since I was last here speaking to you. I think in the first part of the year there was a lack of clarity both in the data and because of the uncertainty in the international situation, knowing that tariffs were coming. And there was the arrival of the predicted hump in inflation, which is now unfolding as we expected in our February forecast. So at that time I felt like I needed to wait and see and have more clarity on what tariffs were going to do and whether the labour market would continue cooling, whether wage inflation would continue to come down. And I think that became clearer as we got into May and June, particularly as we started to receive data on wage settlements. And I still think what we said a year ago or more about the crucial role of wage inflation in feeding into services inflation was the key thing for this last mile of convergence to sustainable levels of inflation at target. So I think it's about balance of risks, which have already been mentioned. It's just that I see the balance as being in the other direction than my colleagues. I'm cognizant of expectations needing to be taken into consideration. And it's true that household inflation expectations are somewhat elevated, though not dramatically relative to their historical mean and standard deviation. On the other hand, financial market inflation expectations are more benign and have actually been coming down more recently, and firm inflation expectations are in the middle. And exactly what signal-to-noise ratio those different types of inflation expectations have it is important to take into consideration. So I think on that we need to watch inflation expectations, but that for me they're not flashing red yet. Whereas if that's the main concern on the upside, I think for me on the downside it's more a constellation of risks where multiple things could crystallize, both domestically and internationally, and that I think are all in play. So I think wage inflation is coming down. We're seeing readings for this year which are in line with our agents' prediction in their survey in January. They were predicting a number like 3.7. I think the current average in the settlements database is 3.6 for calendar year 2025. And as I think I mentioned in my previous testimony, as you go through the year, as we went through last year, those wage settlements tended to be slowing down depending as you went from January through to December. As you went through each successive month, the later settlements were coming in lower than the earlier settlements. And I speculated when I last appeared that that pattern might repeat this year, and that is what we're starting to see as we're starting to see settlements coming into the data set for the latter half of this year, and particularly in the final quarter. We're starting to see settlements around 3, 2, or even lower. And that's confirmed through more anecdotal evidence when I go out with the agents and talk to businesses. I say, what are you thinking of doing next year for your wage settlement? And I'll ask the agents, what have you been hearing about what they think will come next? And it's generally coming in the low 3s or thereabouts, and possibly lower, suggesting to me that we are completing that last mile of that trajectory. So the concern about inflation expectations has to be weighed against the actual incoming data on wages, because I think the most risky channel for the transmission of inflation expectations back into inflation, actual inflation, is through wage bargaining. But I think given the softening in the labour market, and we can come on to unemployment and the slack in the economy in due course, that risk of inflation's feeding through wage bargaining is abating as the labour market softens. I'll come into the other risks in the constellation there, but I wanted to emphasise the wage issue as the most important. I think the hump is a difficulty. I knew kind of in May and June, I looked at the hump and I said, Alan, when are you going to kind of, maybe look a bit out of line? Well, it's going to be when the hump reaches its peak, which is around now. So I have faith in the underlying disinflation process, but we've got a disturbance now, which I don't think is a manifestation of persistence from last year or 2 years ago. It was a new set of shocks that we got in January, administered prices, taxes, a little bit of an energy shock, and now some food shocks. So I think I'm trying to see through that, but this is the hardest time to do that. I think the tariff situation, we're now at the highest tariffs in the post-war period, or since the 1930s, in terms of what's happened with the new US policies. That's only just starting to manifest, I think, in what we're seeing in US data, and I think it's only going to trickle through in the next year or two into the rest of the world as trading patterns rearrange. So I'm expecting, we're seeing it in some sectors, maybe autos, a lot of cheaper goods that couldn't make it into the US market will start to wash up on our shores, on European shores, and therefore affecting us through intermediate products in their market that then filter into our prices. So I think a lot of that is coming and will be loading into the 2026 economic conditions that we face. So all of those worries are in the back of my mind. I think the tariff issue is a little bit undercooked in our baseline forecast, so there's a point of disagreement for me there. There's also a point of disagreement in terms of the current output gap or the slack in the economy, which I think is a little bit worse than our current model is suggesting, because we're putting a lot of weight on the nominal block, whereas I think the rest of the signals are saying the economy is a little bit weaker. And then, of course, lastly, I tend to think the neutral rate of interest is quite low, and so I feel we have further to go to reach neutral, which leads me to think, therefore, currently we're more restrictive, and that we're plenty restrictive enough to take the remaining underlying inflation out of the economy, and I think we're seeing that in the way the wages are developing. So overall, I'm more in the 4+1 camp in terms of how many cuts per year, maybe 4 or 5, rather than 4 minus 4 or 3. And so I think that led me to my vote.
Okay, that's very comprehensive. Thank you very much. And Governor, we've talked before here about that gentle trajectory towards the 2% target, a cut of 25 basis points. What was the reason for your decision?
So look, I mean, I won't repeat everything else that's been said. I'll sort of just position myself, if you don't mind, around the colleagues. So I agree with Megan and Claire that I think, well, Alan said it as well, that we have got, the risk on inflation has gone up. I think where I differ a bit is that I think I'm more concerned about the downside risk on the labour market. I think there is more evidence of some weakness in the labour market coming through,
the pay number, the pay number came in under where we thought it would be based on the May forecast. So I put a bit more emphasis on that downside risk. That's context. Policy, I do think, remains restrictive. That's important. It needs to. So the question then is, as Alan was saying, is how to then judge the hump. I think the causes of the hump are mainly not telling us about the underlying state of the economy, but it is inflation nonetheless. I mean, we can't get away from that. So the question is it going to create persistence risk? Well, I think context does matter here, and this is where my concern about the potential weakening of the labour market is relevant. So for me, I think the judgment was this. I thought it was appropriate, given that downside risk, that we did a further 25 basis points. But I think I also thought it was appropriate that we gave a message which focused on this inflation risk. And what that really turns into is a judgment that although we've taken a further step, and although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps. That's the message I wanted to get across. Now, I think actually, judging by what's happened certainly to market pricing since then, I think that message has landed.
Okay, well, thank you all for your comprehensive answers. Always helpful to have flesh out the official minutes. Chris Coughlin, MP.
Thank you, Chair. From what you've all been saying, if I'm reading correctly, I'd say, with the exception of Professor Taylor, it appears that growth and inflation risks have decoupled, perhaps. So I'd be curious about your views of, is the UK stuck in stagflation?
Well, I'd be happy to start on that. I mean, stagflation is not a word I tend to use because I think it's not a word that is has a very clear meaning. So let's take the two parts to it: inflation and growth. We've all talked about the inflation hump, so that's, in a sense, I'm not going to repeat that. There is obviously an upturn in inflation. By the way, the hump is about 0.3% of a percentage point higher than we thought it would be, both in May and in February, actually. So that's the sort of dimension of it. On the growth side, I think come back to what Claire was saying. Claire made a really important point that the risk here is actually on the supply side. It's on potential growth. It's not so much on the demand. And the way of kind of really putting a sort of sense around that is that we think that the potential growth rate of the economy is currently around about 1.5%, and has been, by the way, for some. This is a description of most of the time since the financial crisis. Hasn't quite been that level, but that's a broad description of it. Prior to that, it was about 2.5%. So that 1% reduction in the potential growth rate is significant, and it's significant not just for monetary policy, but frankly, it's significant for other areas of policy. It's very important, and as Claire said, you can trace this back to both productivity, which has been weak, and has been weak really since that point about 15 years ago, and the other contribution to potential growth, which is the growth of the labour force over time. The question of the increase in the average age of the population is very significant, and it's a point I talked about at Jackson Hole. This, I think we all know it's happening, but I don't think it really features enough in the sort of the discussion of the issues around policy. It is very significant. Now, as long as we have those two sort of, if you like, sort of things restricting the potential growth rate, then we have got this tension. I think the tension runs through policy. And so I would say, again, it's very important, as Claire said, that, and it's not really for us then, but these supply side issues are the focus really of attention in policy making more broadly.
Does anyone else have any views on the stagflation point?
I mean, the only thing I would add is we're not in stagflation, and actually it links to the original answer that Andrew, the governor, gave in response to the independence question. Our target is 2%, and we will get inflation sustainably back to 2%, and we'll take the action needed to do that. And as discussed, we do have growth, 1.5%. So that is growth. It is not as strong as we would all like it to be, but we are seeing growth, and we are taking action to bring inflation down.
But of course, financial market expectations of inflation are consistently higher than the expectations of the bank. Does that ultimately undermine the credibility of the MPC?
Financial market expectations for inflation are well anchored, actually, around our target, and that is an important thing. And it comes again to this point about credibility, which is a key part of our the structure that we have in the UK. So, actually, we are seeing those expectations anchored. When we look at inflation expectations, what we are seeing is we have seen on the short-term expectations of households, to a lesser extent businesses, we're seeing some movement there, but as Professor Taylor said, they're quite small by historical standards, but of course, because they're so important to the inflation formation process, we look at them really, really carefully.
I just add on a very basic level, if you look at our forecast, we have growth and underlying growth picking up from next year through the forecast period, and inflation coming down towards our targets, so that we're not forecasting stagflation.
Sure. And there's been a lot of concern in the news at the moment about high bond yields. I'd be curious to know your views on why you think that the UK currently has higher bond yields than France, even though France's debt to GDP ratio is higher, and actually the French government is at risk of collapse.
Well, we've got quite a substantially higher short-term interest rate than France, because France obviously is anchored by the ECB's rate, which is 2% currently. So that's an important point. Having said that, I mean, you've seen a steepening of yield curves across the whole developed world, really. Yeah. So I do think two points I'll make on this. First of all, the underlying driver of this is global. Indeed, when you look at UK yields in terms of the steepening, we're actually about in the middle of the pack. So Germany and Japan have gone up considerably more than us. US less than us. We're in the middle in that sense. I think France has steepened quite a bit more. They've got their own obviously well-known issues. Yeah. That's the first point I'll make. Now, on that point, going back to my previous answer to the earlier the previous question you asked, of course, that does bring these supply side issues into sort of sharp relief. This question about the potential growth rate, particularly in the context of fiscal policy. The second point I'll make is that I do think it's important not to over-focus on the 30-year bond rate. Of course, it's a number that gets quoted a lot. It's quite a high number. It is actually not a number that is being used for funding, at all at the moment, actually. Historically, the UK has, because it was a very sensible policy, which Claire was actually heavily involved in doing, of course, to lengthen the maturity of the UK debt stock. And there's real benefits of doing that. It was possible to do that while structurally, particularly the defined benefit pension world, these schemes were sort of still growing and they were demanding those sorts of assets. They're mostly now mature schemes, and this comes back to the aging of the population, actually. Yeah. So the structural demand for long-dated, long maturity bonds has gone down. And I think sensibly the Debt Management Office has actually shortened the profile of their issuance to reflect that. So there's a danger that we get sort of slightly overly focused on long yields, because just to end with one fact, I think when you look, I'm not, as I say, Debt Management Office, the experts on this, I think when you look at the cost of debt issuance in the course of this year, overall, the average cost of debt issuance is at least flat and possibly slightly down. And that's because if you look at the 5-year rate, which is much more tied to our decisions, it's actually gone down. So there's a lot of rather sort of, dramatic commentary on this going on. I wouldn't exaggerate the 30-year bond rate.
Okay. Thank you. Bobby Dean, MP.
Thank you. I think I'll actually start with a preliminary question if I can, because Professor Taylor, you mentioned about where you think the neutral rate is and you're at the low end. And I just wondered if each of you could give me a sense whether you have a number in your head about what the neutral rate is, or whether you judge that as it goes, and if there is kind of any discrepancy between you as a panel, really. Could I start from right to left? So Megan Green first.
Yeah, sure. So trying to pinpoint where our star is a losing game. It's impossible to observe. It's impossible to measure that specifically. So, we've put out a few boxes in monetary policy reports providing ranges. I think the important thing to note is that there are a lot of reasons to think that the neutral rate may have gone up over the past number of years. So I think it's higher than it was. I could give you a number, but it wouldn't mean much more than anybody else's number, which is to say not a huge amount. I do think, though, that rather than coming up with a specific number for R star and trying to judge how restrictive you are on that basis, there are other ways to measure how restrictive monetary policy might be. And one way is looking at the monetary transmission mechanism, how much of policy has come through, how much is still to come through, and observing how much monetary policy is bearing on the real economy. And I think there are indications that we're still restrictive, but I'm not convinced that we're meaningfully restrictive. We've been in a rate cutting cycle for a year now, so it can't go on forever with us also being restrictive, and I think we're getting closer, which is an obvious statement in many ways because bank rate is coming down. But
well, I think I can confidently predict as you go down the line, you'll probably realise there are differences, quite important sort of philosophical differences of view on this question as to whether we know what R star is. I'm actually pretty close to where Megan has just described, so I won't repeat everything she said. I really agree with Megan that I use far more the sort of the approach of saying how restrictive are we judging by the monetary transmission mechanism. I think we're probably a bit more restrictive than Megan thinks we are. One of the and just to draw out one point there, the mortgage market is obviously a very important part of that story, and because of course we've switched to having a mortgage market which has gone from a variable rate to sort of 5 to 7 year fixed rates, it means that the transmission mechanism takes longer. So this sort of question about how restrictive we are does adjust over time. I think we said in the box we're probably past peak restriction now. That's not surprising because we've been cutting rates, but because of the lag, it takes longer to get to that peak point. So I think we're past peak restriction. I'm probably, though, my difference with Megan is I think we're a bit more restrictive than Megan thinks we are. But we're basically in the same sort of philosophical camp, I think.
Sure. I mean, actually, I'm in a very similar position to Megan, I would say, which is, I think, and on this philosophical point, I mean, like the Governor and Megan have said, I mean, I think you can look at this in two ways. You can do the sort of model-based analysis, and you can do the sort of what does the data and sort of, as you think about the analysis of what we're actually seeing in the economy, what do those things tell you together? We do both to try and understand this and to try and get as much information as we can. I tend to put more weight on the evidence of what is happening in the economy, and personally, I think it is basically impossible to know sort of what the neutral rate is, certainly in real time at the point at which you're making your policy. So there's a lot of uncertainty around this, but I think I would put myself, closer to Megan in that I would put myself at the upper end of the sort of range that the bank has set out. Analytically, we've said it's somewhere between 2 to 4. I'd be surprised. I would think I'm more likely in the upper half of that. But very, very hard to know, and so but it's one of those issues that we debate and discuss and put a lot of effort into.
I kind of wasn't expecting a number from each of you, to be honest, but it's just interesting here because of what you said, Professor Tully. Because for me, if you feel like because obviously the restriction has an impact on the economy too, right? As you know,
yes.
And so if you feel like we're too restricted at this moment because we're too far away from where we need to end up being, you may feel like now is the time for more urgent action to get towards that place. And I don't know, Professor Taylor, if you could elaborate what you meant when you said that, and if you feel that because of the things that you've already described about how a lot of the inflation stuff that you think is driving it will dissipate over time, that now's the time to act faster. Could you elaborate on that?
Yeah, I think that was very much part of my thinking, that if I saw a greater weight of downside risks and that I felt based on my estimate of neutral that we were more restrictive than maybe my colleagues, then I felt we had more space for an extra cut this year, and I thought the extra cut was justified on insurance grounds when I saw that constellation of risks building. So yeah, I think that contributed to my feeling that we had quite a bit of space left to run.
Okay. Then the other thing that I've picked up in the discussion, you've all talked about sort of the supply side as well. Is that a signal to government to do particular things as well? Because the tools that you've got are obviously quite blunt. You have the interest rate, you've got QE and QT as well. That's the armoury you've got when it comes to monetary policy. Is there anything you would like to see, or are there any thing that you'd like the bank to have more control over, really? I'm trying to understand whether or not you feel like you've got the tools you need to do your monetary job. And I know it's going to be hard for you to answer.
Not in the market for more control. Look, I think, and by the way, these issues, as I said earlier, are not unique. I think it's really important. This is not unique to one government. These have been going on for some time. I mean, John Glenn and I have discussed these in the past many times. So I think, look, I'll come back to the points we've made before. Two things. On the productivity side, I mean, it is important because productivity in this country has been weak now for quite a long time. investment is an important part of that story. So I think, you know, things that the government is doing, and by the way, the previous government, you know, was also doing, because there's no difference here on things like pensions reform, I think are important. Things we did on long-term investment in the past, which we were though involved in, are important because these are the things that can create the, you know, the ability to improve investment in the economy. So that's one thing. The second thing on the ageing of the population, and again, look, the UK is, I mean, all developed countries are in the same place, so there's nothing unique about the UK in this respect at all. I just would say, I do think it's important to have these issues thoroughly on the table and to make sure that they're sort of well understood, not just in this building, but more generally, because I think the importance of this issue as a headwind, a structural headwind, you know, it is critical. I mean, it is a very important issue in terms of what, not just in, you know, in terms of both of the, you know, the labour force, and in terms of, you know, the cost of health and welfare.
And can I take from that you don't think it's central enough to public discussion at the moment? That this demographic problem we have in ageing society, you don't think it's central enough to our public discussion?
I think, look, you know, I'm going to stop because, you know, I'm getting very near to the edge of my remit, as it were. All I will say is, and of course you're very keen to get me onto that, but look, I would say this. I do think it's important to explain the underlying issues. It's really important to explain the underlying issues here. And they affect us, obviously, but they're not for us to, you know, to take on the responsibility for.
Do any others want to add to that? No, I'll probably tempt you outside your remit, that's fine.
Thank you very much indeed. I'm going to now adjourn because we're expecting a vote, so order. Order, order. Welcome back to the Treasury Select Committee on Wednesday, the 3rd of September 2025. We're resuming our session with the Monetary Policy Committee, focusing particularly on their decision on interest rates in August. And I'm going to ask Ms Lola McAvoy MP to kick off. Ms McAvoy.
Thank you, Chair. Governor, we were talking about the increase to inflationary pressures, and I just wondered if you could elaborate as to why the committee still believes that these pressures are temporary, and why and how they differentiate between the 2021-22 pressures and now.
Yeah. So, first, I mean, two parts to that I think. The first one is obviously what's causing them. And then the second one is what I would call the context in which they exist and where we think they go to. So I draw out a number of causes in sort of buckets. One is, as we were saying earlier, I think before the break, that there are certain sort of what you might call administered prices. So this is things like vehicle excise duty, water bills, bus fares, which are not, I mean, it's obviously inflation because prices are going up. It's not particularly telling us about the underlying state of the sort of demand and supply in the economy. There's a second group, as we said, which has emerged a bit more in the recent months, which is food. That's again a mixture of things. Three things I draw out there. One is some global commodity prices, coffee, cocoa beans, beef being the three things that we hear most about, I think. And then the third one is labour costs. And bear in mind that the food industry, both in terms of production and retailing, has a larger share, particularly of people on or around the national living wage, which has gone up more. So if you look at the average weekly earnings data and you use the breakdowns, you will see that inflation and the increase in wages in those sectors are higher. So that's the food components, and as we said earlier, food is important because it's salient, as we describe it, because we buy it regularly, and we obviously buy a lot of it for good reason. And then there's a third, so we've done most of the prices, we've done food. I think the third thing then is this question about wage pressures, which I think now are coming, they are coming off, but obviously they have been higher. So those are the things I draw out as causes. Now the question you rightly ask, well, why is this different to 3 or 4 years ago, and therefore why are we in the situation of saying, well, we think, and our central forecast is that this will come off starting sort of around the end of this year. By the way, there's some signs with food that the commodity prices element is beginning now to come off, although we think overall food inflation probably will peak around the end of this year at just over 5%, I think is the current number. It's 4 something at the moment. Context matters here. So the context, as I said earlier, is one of a weakening labour market situation. Growth, as a number of us were saying, underlying growth has been subdued, but it's in our central projection it's going to be around the sort of potential growth rate, around the 1.5% level. But there is some evidence of the labour market weakening at the moment. So that context judgment is important. As I think Alan was saying earlier, we think that there is an output gap opening up. I think there's slightly different views amongst us probably about how much and what the profile is and what causes it, but there is some evidence of slack in the economy. And those are the judgments that are key as to whether this hump is going to go away or whether it will create some persistence.
Okay, but the general consensus is that the pressures that we're facing today are not as severe as 21-22?
Well, they're not. I mean, thank goodness, because we're not seeing the same shocks. I mean, you take the food price shock. I mean, food price inflation peaked at 19%. Now, a lot of that was obviously the Ukrainian effect. So, yes, we're seeing an increase in food price, but we're not seeing that sort of effect.
Thank you. And you mentioned about GDP growth. And how much do you think the global shocks that we've seen in the last 18 months compared to sort of forecasting, which is a very difficult job of global shocks coming down the line, how much of that is a factor in your predictions for GDP?
So I think it's interesting there. You probably detected from each of our answers to the sort of the initial question about why did we vote as we did, that we didn't say a great deal about the international situation relative to the domestic situation. And I think that's because probably speak for my colleagues at this point, that I think we were all of the view, although we take slightly different views on the domestic situation, that it was the driver really in the decision. Now, why is that, given that the global situation is so much in the news? And I think a couple of things there. One is I don't think we're seeing inflationary pressures coming through from the tariff situation as of yet. We said, I think, back in May, and possibly at the hearing we had after May, that the impact of tariffs when you're on the receiving end of them is ambiguous from the point of view of inflation, because if the world economy started to fragment and we got supply chain pressures, as we did after COVID, of course, that would be inflationary. If we get redirection of, let's say, Chinese exports, let's be blunt about it, if we get more, then that could be disinflationary. So it can go both ways. We're not seeing a lot down that channel at the moment, but it's still relatively early days on that front. So we can't say that's over by any means. I suppose the other thing I'd say is that, and here I'm going to sort of do a bit on the one hand, on the other hand, if you don't mind. So tariff levels at the moment are lower than we thought they would be in May. Of course, I have to say, they are still very fluid, of course, as you judge from the news. And that's on the one hand. On the other hand, I will have to say that they, having said that, they are still at the highest, US tariff levels, at the highest level since the Second World War. So let's not underestimate the significance of this. But it isn't as big a part of the story from the point of view of UK inflation as probably we feared it might be. But we have to keep watching this very closely, I would say.
Thank you, Governor. And then Ms Lombardelli, for 2 consecutive quarters, the bank underestimated the near-term growth of the UK economy. Do you think the bank's being pessimistic, or is that because of the lack of stability more generally across the global sphere?
Yeah, I don't think we're being pessimistic. You're right in that for Q1 and Q2, those numbers came in above what we expected. We spend a lot of time thinking about what's going on in the sort of underlying position of the UK economy, because this data is quite volatile. So, if we take the Q2 number, it came in, I think it was 0.3, we expected it to be 0.1. If you look at what those differences were, they were pharmaceuticals, health, some business-to-business services. They were quite, these things move around through time. And so, does it tell you a lot about the underlying? We don't think so, but we spend quite a lot of time looking at our forecasts, their accuracy. We look in particular at, are we seeing they're particularly over-optimistic or under-optimistic? Are our errors on one side or the other? Broadly, they are balanced. We're as often above as we are below, if you like, and that I think is important because it does give you the sense, it allows you to check, is there something systematic going on in terms of getting this wrong? Now, we are actually putting a lot more effort into our forecast evaluation in response to the Bernanke review, because this picks up on one of his recommendations about incrementalism and looking more fundamentally at your forecasts each time, so that you don't just compare this one to the last quarter, but you actually say over time, are there things going on? So when we look at that, we don't see systematic biases, one side or the other, which provides some reassurance. But it's always important to sort of keep your eye on this and to check what you're doing. So I think it's that. The other thing I would say is, we're not in the business of forecasting shocks to the economy, right? We kind of assume there won't be a shock, because how could you scale that? How could you do that in a meaningful way? So, in a sense, I'm not surprised that we see errors. I would be very worried if we were seeing systematic errors in one direction or the other, and that's why I think it's really important that we put some more resource into thinking about this. This is what we're now doing.
Just on the last 10 quarters, I think we've been over in 6 and under in 4, so it's not a particular. And by the way, that's to the second decimal place. So people say shock horror, you make error. Well, no, you'll always make errors to that point. You don't get them.
Thank you.
Precisely right.
Thank you. Dame Harriet Baldwin MP.
Yes, thank you. And Governor, you've now been Governor for 5 years or over 5 years, and it's been a torrid time. There has been this period that we've heard about from Ms McAvoy, but overall our constituents on average are spending 28% more for the same basket of goods than they were 5 years ago. The target, obviously, cumulatively over 5 years would be just over 10%. So I wondered if, looking back on that full 5 years, not just August, you can pinpoint any of the, what you think were the Monetary Policy Committee's worst judgment calls in that 5 years.
Well,
Governor.
I can give you an answer which looks at sort of the shocks that we've had, and I can give you sort of which ones have sort of which ones have, it goes back to Claire's point about forecasting shocks, and I'll tell you which ones have sort of surprised us and which ones caused me to reflect. So, look, I mean, obviously, I became governor just as COVID was breaking out, so I don't think any of us sort of could have forecast COVID itself. I would say the same about the Ukraine war. I don't think any of us could have forecast the Ukraine war sufficiently far in advance. I mean, I think the one that's interesting for me, and by the way, I have to say this, that not only did we not forecast it, I don't think anybody forecast it in the world of forecasting, but I think it's important, and it comes back to things we were saying earlier, is the fact that when you look back at the post-COVID period, the UK appears, and I say appears because of the problems with the data, but let's take it at face value, to have had a negative shock in labour supply. So coming out of COVID, it appears from the data that the UK has had a negative shock to labour supply. Now that puts us in an unusual position in comparison with other countries, and has, I think, been part of the inflation story, because we've obviously spent a lot of time on question about wage increases, for instance. Now, I have to be honest with you, I don't think I still really understand why the UK is in this unusual position, to be honest with you. But it comes back to this point we've been talking about supply-side shocks. Because these shocks are really supply-side shocks. They're not demand shocks, they're supply-side shocks. The people who say, well, UK demand ran ahead post-COVID, no, it didn't. I mean, frankly, the UK story on growth, on consumption, on investment is not suggestive of that. So the one that I think really causes me to reflect, but I have to say, I think, we were all in the same boat on this one, is this negative labour supply shock.
Turning to last year's budget, which was, again, I think surprised the economy in terms of its scale. And you came to see us last November, and you said that you were having a neutral forecast in terms of how the economy might react to the budget. You wanted to see the evidence. Yeah. You said it could feed through higher inflation, fewer jobs, slower wage increases than otherwise, a squeeze on profit margins, and an increase in productivity. And I just wondered if you could update the committee in terms of those 5 things, what you're thinking now were the main ways in which the economy adjusted to last year's budget.
Well, I think, first of all, it is still evolving, obviously, to be fair, so it's not over. This was particularly on, by the way, this was particularly on the national insurance contribution point, really. And we set out the channels. And we are still seeing, and when we talk to businesses, we still see that, the response is not dominated by one channel. I think at the moment, the evidence we would certainly get and our agents would get is, and this is not surprising, is that probably initially more of it comes through in margins. But we are seeing now adjustments, particularly in the labour market, so both in numbers and in hours and in pay. Now, I don't think any of that's surprising. It's not actually contradicting what we assumed last year, because of course, if all the other adjustments take time, so adjusting your labour force takes a bit of time, adjusting pay, if you have pay increases that are lower than they would otherwise have been, that takes time. If that takes time, the first thing that takes the strain is the margin. So I don't think there's anything surprising about that. So I think we're still seeing a mixture of effects. It's not out of line, particularly with what we were, I think, expecting.
I guess from your point of view, from the Monetary Policy Committee's point of view, it would be the higher inflation. If you had seen the ability for businesses to pass on price rises to consumers exceeding your expectations, that would be a worry. And I wondered whether you're seeing any of that, and how that feeds into the overall inflation expectations in the economy, which seem to have risen to sort of more like 4%. People don't seem as confident as you are on the committee that we'll see inflation return to 2% again. They seem to have embedded this 4% idea. So I just wondered how much, whether it's in line with your expectations, the extent to which businesses have been able to pass on price rises to consumers.
I think it differs from sector to sector as well, as to how much is being passed on, partly because of the state of demand, but partly also because in some parts of the economy, and particularly those parts of the economy where a larger part of the labour force is at the living wage or around the living wage, then one of the channels is closed down in terms of the ability to respond to it, because if you've got staff on low pay levels and the living wage is the sort of controlling variable, then you can't set the pay increase level lower than you would otherwise do effectively. So I think that it's certainly the case that we see when we look at the breakdown by sectors. I mean, I was mentioning food earlier. I think you can mention probably some parts of the services sector. We are seeing higher wage increases because of the inability to, in a sense, pass it through down that channel. So it does differ from sector to sector. On your point about what people expect, I mean, Claire was making this point earlier. Short-term inflation expectations measures do respond very closely to headline inflation. We know that. And by the way, I'm not surprised. I mean, that's logical. And you're right, therefore, that tends to create the view that people don't think that inflation is going to come down because they're setting their expectations based on what it is today. And it's our job, obviously, then to set policy to achieve that, to return to target, as Claire was saying. That's our job and we will do it. And that's why policy is restrictive.
But do you see any evidence that the public is losing trust in your ability to control inflation?
Well, I think Alan was saying earlier that no, in the sense, look, there's a number of different measures of expectation. So there's public, there's individuals, there's businesses, there's markets. Markets, certainly, inflation expectations are anchored, and they're anchored around, inconsistent in my view with the target. Business expectations are in the middle, but they do, show that they expect inflation to come back down again. Public, as I said, because and I can understand this, there tends to be a larger element of what is today's inflation rate influencing expectations. And I think what I look at particularly then is are we seeing public expectations moving even more than the current inflation level would suggest? And we're not seeing that, no.
Thank you. And if I may, Chair, can I just ask a quick question of Ms Lombardeli about the Bernanke review, because you very helpfully provided us with a very long written summary of where things have got to in terms of implementing the Bernanke review. I'm just interested on the modelling side of things, because you've added 30 staff to help with the changes to the models. How long do you see that project taking, and do you think the models have correctly assessed those factors that I was just asking the Governor about, and more importantly, inflation expectations in the economy?
Yeah, well, look, thanks for asking. On the modelling, so we're making good progress on the modelling. We've actually completed some things for example, our workhorse that we use for the central forecast, the DSGE model Compass. We've updated that. That's been re-estimated now, and we've also built in, for example, a much more sophisticated energy sector, which will pick up directly on some of the issues around what's happened over the last few years. And we know that energy is a sector that's provided quite a lot of shocks and volatility, and so it will sort of help with that. So, that's an example of something that we have basically completed. We're making good progress on our semi-structural model, where, with a lot of help from the ECB, actually, we've used to sort of shortcut the process of doing that, but that will take time. We've also got some more sort of statistical models that we are building, which are particularly helpful for some of the short-term inflation forecasting that we talked about. So these issues around what do we think is going to happen to the components of inflation over the next 6 months. We've got further to go, quite a lot further in some, building models takes quite a bit of time, particularly some of these supply side issues that we've talked about takes a bit of time to think about that. The economics profession typically has spent less time on those sorts of models, and so we've got further to go. So I would anticipate for some of that modelling it's going to take a few years to have a wider suite online. Some of it is being used now, and actually we've used the new Compass model in a few rounds already, and that contributing to what we believe to be
better forecasting. So I think you'll see it over the next few years coming on. I would say also part of this, I mean, the big change from the Bernanke review is a sort of philosophical one about having a much broader range of analytical inputs. And that might mean that we're building models that we're not using for the central forecast, but we might apply, whether that's to scenario analysis or to just looking at some other variables in the economy. So, it's a piece of work, it's a sort of evolving piece of work. I think it'll take a few years, but we are already seeing some of the benefits of that now.
And he wanted you to abolish the fan charts, and the fan charts live on. So do the fan charts stay until you finish this modelling work?
Not necessarily. I think, so the issue, I mean, the fan charts raise a broader issue, which is this question of how should we use and think about uncertainty and communicate uncertainty. And the fan charts are one way in which that has been done in the past, actually a sort of very powerful visual representation of uncertainty. Dr. Bernanke had two sort of criticisms of them. One is the way we were using them wasn't really as grounded in analytics as it should have been, and we've stopped, in a sense, making kind of ad hoc adjustments to the fan charts, or making ad hoc, but making adjustments that were less analytically based. We have kept them in for now because we are still thinking about what is the best way to communicate uncertainty around a central path, and uncertainty more generally, where there's a role for scenarios, there's a role for other ways of thinking about and talking about uncertainty. Until we've sort of decided what we think is the best way to do that, we're still maintaining the fan chart. They do have I think an important kind of, they provide an important demonstration of uncertainty. I mean, we always say don't look at the central path, look at think about the kind of distribution, and it allows you to do that. But so, I mean, we're basically thinking about this still. We haven't taken a final decision on what happens to the fan chart. We have taken a sort of initial steer from Dr. Bernanke to, if you are using it, use it in an analytically based way.
Thank you very much, Dame Harriet. John Grady, MP.
Yes, thank you very much, Dame Meg. Just back to the food price inflation, which matters a lot, obviously, to my constituents. Now, you've talked about global commodity prices, coffee, cocoa, beef. Perhaps a question for Ms. Lombardelli. What are the underlying causes of that inflation? What's pushing it?
Well, as I say, we've looked at this quite a lot, and both in terms of the analytics of the data, but also talking to people across the sector, both production and sales. I think there's a few things going on here. So for those goods that the Governor talked about, a lot of that is about, for example, the price of animal feed. Right, which we just, it feeds into the cost of beef, butter, as well as, other sort of dairy and farm products. We know that. Now, there is some good news there in the sense that appears to be coming off, and so we would ultimately expect that to feed through to lower prices, though, as I say, we expect food price inflation to go up before it comes down later this year, and unfortunately peak just before Christmas on our central expectation. So you've got this question about things like animal feed and other agricultural crops. Cocoa was the other example. A lot of that is weather. Is actually just driven by weather and about sort of harvests and the timing of and abundance of those. So that's the sort of big driver of some of those agricultural products, and as I say, feed that then goes into others. There is also an issue about changing global demand actually for those goods. So we've looked quite carefully at sort of who is consuming what and why. It's not the case that people in Britain eat more butter than the French or drink more coffee than the Italians. Actually, it's quite similar. But we are seeing some changes in demand globally for things like cocoa as coffee becomes more popular in sort of parts of Asia, for example. And so that does change the demand. So it's sort of this combination of demand and supply. But as I say, in particular for the goods that we've been talking about, actually weather patterns have had quite a big effect.
And just a quick follow-up, first of all, on animal feed. What's, in your view, is driving the increase in the cost of animal feed? Is it energy costs or...?
A lot of it is these sort of the impact of the weather reducing the supply, basically.
So just thinking about those causes, weather takes you to, climate change and so on, and what's going on in places like Spain. Changing global demand takes you to global economic growth, the rise of China and the ASEAN economies. None of those feel particularly temporary to me. So why are you confident that this is a temporary phenomenon?
Well, I mean, we're confident, so this is our sort of central expectation. I mean, actually, we've got some scenarios that look at more persistent inflation. But if you look at the sort of what's happening in these commodity prices at the moment and sort of forward prices, you can see some of that coming off, as I say. on the feed side. And these things are just volatile and vary on these things. So if you talk to people who are in the industry for these markets, they are expecting these prices to come off, and so they expect some of these prices to go down basically into next year. If there are other shocks, if we were to see another set of adverse weather patterns with an impact on supply, we might see them again. Similarly, if we don't see that, or indeed the opposite, there have been some goods, I think olive oil, sugar would be examples, where actually you've had much greater supply than expected and prices have come down. So it's this sort of combination is the reason. The other thing sort of longer term, and this actually comes back to some of the issues about supply that we were sort of thinking about, is there are, of course, always changes to productivity in these sectors, and some of these sectors are ones where actually sort of technology and the application of technology will, over time, well, that's a much longer time horizon, have an impact on supply.
Just simple economics as well. If global demand for coffee goes up, you would expect global supply over time, supply of coffee to go up, because there will be an incentive to grow coffee. I don't know. I have to be honest, I don't know how long it takes to rear a coffee bush to create it, so I'm way out of my...
Well, that is the thing, of course, isn't it?
There's not many in Glasgow, I'm sure, but unfortunately...
Well, we'll see what we can do. But on the prices of food, why is, given these global factors, why is food inflation higher in the UK than in the Eurozone? Do you have a view on that? Perhaps again.
Yeah, I think, actually, and we had a chart in this in our August report. Actually, in the Eurozone as well, food prices have gone up. These are global commodities, as you say, and actually there's a very lively debate, if you spend much time in Europe, about the price of coffee at the moment, for example. So you do see that they're tracking. There are a couple of things, though, that are different. So as the Governor talked about, a large proportion of the workforce involved in food production is on or close to the minimum wage, the national living wage, and so that has an impact. There's also quite a big difference in the labour, what's going on in the labour market in Europe versus the UK. The European Union, and we should be clear, there's a lot of variety across the labour market. The labour market in different parts of Europe is very different, but in general, there's more sort of slack in the European labour market than there is in the UK. There's more labour supply, and that means actually wage pressures have been a bit less. There's a few other timing issues in particular, like some of the regulatory changes we've seen around packaging, for example. Although I think that's more timing, because again, the European Union are doing some of that just to a slightly different time frame.
Now, we talked earlier about not being in the business of forecasting shocks, and also the Ukraine shock. One thing that does worry people is China and Taiwan. What impact would a major crisis in that context, given rare earths in China, semiconductors in Taiwan, what impact would that have on inflation? And has the bank turned its mind at all to that, Governor?
Yes, it comes back to the point we were making earlier, which is, of course, if it led to a breaking and disruption of supply chains, and I would look there, frankly, in terms of predicting impact, if it were to happen, then yes, that would have an effect, and we saw some of that obviously during the COVID disruption. That was different. Ukraine, yes, so Taiwan obviously the world's largest producer of semiconductors, so that's very significant in that respect. So, we do follow these things, and we follow them wearing both of our hats, both our monetary policy hat and our financial stability hat, obviously. I have to state the obvious, we have no ability to influence these things in terms of where they happen, but we do follow it very closely, yes.
And perhaps it's something you could set out in writing then, just about how you do follow it, and any kind of thoughts you have on both fronts, because I don't want to take up too much
we can
time.
Do something, yes. Yeah. Obviously, by the way, we do rely on government quite a lot for this, because obviously they've got the diplomatic network, they've got...
Of course, and it's not so much for will it happen, because none of us know, it's what are the consequences and how prepared would the bank be for that sort of eventuality.
Okay.
Thank you.
Thank you very much,
Thank you,
Mr. Brady. Rachel Blake MP.
Thank you very much, Chair. Ms Lombardelli, the report highlighted a household savings ratio that was up to 11.6%. And also with the July Consumer Confidence Barometer, Savings Index, which tracks people's desire to save, rose to its highest level since November 2007. What's driving this behaviour?
Yeah. Well, one of the drivers is monetary policy, right? So interest rates have been higher. I mean, this is an intentional channel, right? It's one of the ways in which monetary policy works, which is, it makes savings relatively more attractive than otherwise, so people save more. And actually, so that's one of the drivers, and we know this because if you do surveys and ask people why they're saving more, some of them will say it's because of getting a higher return on those savings. So there's definitely that. We also see some evidence, and again, this isn't a surprise, that in response to a series of large shocks that have had quite big impacts on people's economic position, people have chosen to save more. So, I think if I've got in front of me the sort of survey data, and one of the biggest increases has been in people saying they want to save more for emergencies. Now, that's not a huge surprise given what's happened, whether that's COVID or the cost of living and those sorts of issues. So you would expect, in a sense, that sort of precautionary saving to rise. You would expect a change in the incentives, a change in response to the sort of return to saving. So those two. I mean, it's quite interesting. We also look at this question in terms of thinking about the labour market. If you look at have people increased their savings because they're worried about unemployment? The answer to that is they haven't, actually, which is quite interesting, I think. And you would think if people were more worried about unemployment, that would be a reason for them to increase their savings, but they're not reporting that. They're not saying that. We're not seeing it. I mean, they say it, but they don't say it any more than they used to, if you like. So that's just, in terms of survey responses.
And I just probe on that caution point. So you don't have the survey evidence to say that they're any more concerned about unemployment. Right. And are you able to untangle whether the interest rates or the generalised caution are driving the behaviour?
Yeah, I think it's a bit of both. I mean, if I'm actually looking at the data in front of me, and I should say this is survey data, right? So it's not, it gives you a good indication, but I'm sure there's a lot of other things going on. But actually, it sort of doesn't, it asks people to say the reasons, and you can say more than one. So it's quite hard to unpick. But if you look at what's changed, there's definitely something about responding to higher interest rates. That's the biggest change, which you would expect, because we've had quite a big change in interest rates from the start of the rising cycle. And this thing about emergencies, that's a smaller increase, but it's still quite a high level. So I think you've got a bit of both going on there. I mean, I would say this is really important to us because one of the things we have in our central forecast is an assumption that over time, say the savings rate will fall back to a more more in line with its average level, and so consumption would increase, and that is supporting demand in that sense in our forecast. So it is one of the risks we think about quite a lot, which is if we don't see that happening, is that a downside risk to demand? One of the many, I think, that Professor Taylor's talked about in the constellation, and I think that is something that a lot of people on the committee think about, and we are sort of tracking and keeping an eye on.
And is the concern about shock from your data or your analysis to do with shocks, COVID, Ukraine, that kind of inflation, or a different kind of people anticipating more personal shocks and becoming more aware of those? Are people just becoming more financially aware through education about there are good standard reasons to save, or is this a 21st century phenomenon?
Yeah, it's a good question, and I think virtually impossible from the data to be able to tell. I mean, I think it's it's really important. We sit there thinking about these shocks in a kind of macro perspective and how do they feed in, but of course to individual households and to individual firms, they're incredibly personal, and they care about their own finances, not necessarily the fact that everyone else is feeling like that, or indeed what the driver is. We heard the numbers earlier about the increase that people are spending on the same basket of goods. That will be having an impact on, it brings home to people, if you like, the economics and their personal balance sheet.
Thanks very much. And Governor, the experience of borrowing is not the same for everybody in terms of the types of product that they're turning to. So we've seen, in really positive sense, in terms of stability, mortgage rates coming down, but we're also seeing personal loan rates stay quite high. What do you think that's about?
Yeah, you're talking about unsecured loans then, I think, yeah. I think it's an interesting one, actually. So when we look at it from the point, we tend to look at the relationship between the personal unsecured loan rate and usually the swap rate, which will be either 2 or 5 year swap rates.
And what we see is that, and you'd obviously expect the unsecured loan rate to be above the swap rate because you've got credit risk in there. If you look at it over time, actually that wedge between the two is now back to where it was pre-COVID. It actually shrank as we were raising rates, interestingly. So unsecured loan rates didn't go up as much as the swap curve went up. I can't give you a sort of very sort of well-developed reason for why that wedge came down and has now reverted to where it was. You might think it might have something to do with demand for lending. It might have something to do with competition in the industry. I don't know.
We don't know. It could be.
Well, what we know is, I say, what we do know is that although it looks like it's gone up, actually the wedge which to the market rate has actually reverted to where it was, to its pre-COVID average.
This is chart 2.5.
Yeah. Yeah.
So the wedge is staying about the same, but it just happens to be a bit.
Well, it hasn't. The point is, it didn't stay the same.
Yeah.
It's reverted to where it was. So it looks like it's back into its sort of more historical position.
Ms. Green.
Oh, sure. Yeah, I can just add that there's typically a lag between when the 2 or 5 year swap rate comes down and when personal loan rates come down, and so part of it could also just be the traditional, typical lag.
There must be data on whether demand has gone up for personal loans, so that could inform this.
Well, we can send you that data. We'll have a look around and see if we get any more data to illustrate that. We can certainly send you the data that we've just been talking about and illustrate.
That'll be helpful. Thank you.
Thanks very much.
Thank you very much, Ms. Blake. John Glenn, MP.
Thank you, Dame Meg. Can I turn to the labour market? The Monetary Policy Report says that labour market conditions continue to weaken. And I'd like to try and focus on what determines your evaluations of what is happening in the labour market. Lots of assertions are made about national insurance increases or concerns about employment rights bill leading to an anticipation of increased costs. Can you tell us about how you attribute using data to actually get us to understand what that weakening looks like? We heard in your opening statements there's a range of views about your future projections, and I'll come to Professor Taylor about his view about the labour market. But what I'm anxious to understand is, let's cut through the politics and get to the heart of what's actually happening. Governor, would you like to start?
Yeah, I'll start. Well, look, first of all, of course, we have to actually sort of, in a sense, establish what the overall picture is. And that's not been easy because, obviously, there's well-known problems and questions over the labour force survey.
My colleague, Yuan, will come and ask about that.
Our staff spend a lot of time, compiling, and when we publish them in the report, compiling other data sources, some of which are official. HMRC type data, for instance, is very good. And we use surveys. There are a number of surveys we can use to actually try to get at the overall picture. I should say that the earnings data are rather better than the quantity data, we think, at the moment. That wasn't always true in the past, by the way, but it is at the moment. Now, then your very good question, well, okay, then how do you form going back to, I think, Dame Harriet's question, actually, about how do you form a view on what the underlying causes of this are? Well, we do rely on our agents a lot at this point. So our agents, obviously...
The network across the country, people who
so
talk
they have,
to
obviously, a panel, a very large panel of contacts, which we always try to keep it in a sort of balanced, representative, sectoral, firm size type way. And they obviously input to us at every monetary policy meeting. They give us their latest set. And then I think the other thing I'd say is that each of us goes around the country with the agents and sits down with firms and with groups of firms and talks to them. And I can certainly speak for myself. It is very high on my list of questions that anybody I go and visit, because it's a very important question.
Thank you. So can I go to Professor Taylor on this point, because you have quite a distinct view over the situation in the labour market, I think, around a slightly divergent view, perhaps. Could you, given what the Governor has just said about the data points you all access and this wide, quite a lot of qualitative data on expectations, your assessment is slightly different. I think you say that a slow loosening of the labour market can suddenly turn into a rapid deterioration that is much harder to arrest. Could you just say a little bit more about how you see the likely trajectory in the labour market?
Well, I think it's about risks. So I think that the statement about how you can have that nonlinear breakpoint and suddenly the labour market can accelerate in a downturn. I think that comes from economic history, not just of the UK, but US and other countries. And I think it's a point that's shared across the committee, but it's just how big a probability or how big a risk does that represent at this point in time. So I think when we discuss this, it's not like some of us believe that that's true and some of us don't. It's just a question of how proximate is that risk. And I think for me, and maybe even for the rest of the committee, I share the view of the central forecast that unemployment has been, over the last 12 months, and will be, on an upward trajectory. So I don't think I disagree with the slope. I probably disagree with where we are right now, the starting point. I think we're slightly worse than the forecast statement. And the reason for that is that if I look at the models, the nominal block in the model is saying, given inflation where it is, we should attribute the relatively high inflation to demand being perhaps elevated. But all of the other models, based on the real side, based on output and employment, tend to say the output gap is a little bit worse. The economy has more slack in it, and I'm inclined to put more weight on those indicators than on the nominal block, because we've sort of said in another part of our thinking, we have to have an inflation persistence judgment in there, because in a sense the connection between the output gap and inflation isn't maybe playing out right now in line with our historical models. So that says to me, okay, I need to reweight my signal noise ratio over here and pay more attention to the real indicators. And then, you know, I mean, some of the official data versus, like HMRC versus the labour force survey, are disagreeing in a way where, you know, LFS may say it's not that weak, but HMRC numbers have been suggesting maybe it's a bit weaker. So it's a matter of inclination. It's just saying I think we're starting right now from a point where we're a little bit weaker, and that means the risk is the risk gets a bit more proximate.
Thank you very much. Could I pass to my colleague Yuan Yang, who I think wants to take forward on the data points we're all interested in?
Yeah, we're all fascinated by data. I think we all probably all share this, a nerdy group of people in this room who all love data.
Oh, good, excellent.
There we go. We're all excited about that. Thank you very much, Mr. Glenn, and indeed Yuan Yang. You come next. Thanks.
Thank you, Chair. Governor, you've slightly preempted my question about the ONS, which I know that we've discussed at depth in this committee. To what extent does the ONS's new plan for economic statistics address the concerns that you've raised before with this committee, and what are the biggest remaining gaps, do you think?
Well, first of all, I mean, we very much welcome the report that Sir Robert Devereux did. I think Claire actually was involved in sort of in putting to it directly from the bank's perspective, very supportive of it, and I also welcome the ONS's response to it, which I think is a sort of measured and sensible response. So I think then, of course, the plan emerges out of that in terms of what they're going to do. I have to say we have given them one of our best senior staff. Well, not given them, I mean, who's gone to work there, and I'm very pleased. I think, because we want to support them, but it was also a choice that person made. It's good. And so I think we do have to now sort of, all get behind it and make sure that they can deliver it and that they do deliver it. The world of statistics, and because we talk to our counterparts in other central banks, it's not straightforward. There have been a lot of changes in sort of structure and way people as I've said before, way people answer the phone, the way people live. Many countries' statistics agencies are saying it's becoming more difficult. So I think we have to support the ONS, but I think the Devereux report gives them a way forward, and I'm very pleased in that. I think it's right that they're really putting extra resource in at a senior level to lead this. So we will support them through it. That's very much a commitment that we should and will make.
Thank you, Governor. And as an open question to anyone on the panel, while the ONS is getting its house in order, and while it will take some time to feed through to the Transformed Labour Force Survey, are there existing other data sets out there that could enhance your decision making if you were to access them, and what difference would they make? Would anyone like to?
Ms. Green?
Yeah, sure. So as you know, we already look at a host of different series on the labor market in particular to get a clear picture of what's going on. So we don't just rely on the ONS data, we look at other series as well. COVID was a turning point for many economists in finding new real-time sources of that kind of information. So we already look at that. I would say generally, if I were to make a plea for data, To my mind, one of the biggest questions we have is around consumption in the UK because it hasn't rebounded as you might have expected. The savings rate has remained really high, and we do expect consumption to come in and the savings rate to fall, but that is, I think, a vulnerability in our forecast. So understanding the UK consumer better would be really helpful. There are a lot of data series that exist in the private sector, so credit card companies, the banks actually have a lot of data on balances. Getting access to some of that data in an anonymized fashion, just so we have a sense of what people are spending money on when, would be really helpful.
Thank you. Would anyone else like to add to that?
Yeah, I think I fully support that. I mean, when we are now trying to fill gaps, we have to take data from many different sources, amalgamate, think about the signal-to-noise ratio, how can we get some estimate of what's happening to the labour force or what's happening to consumption. But that process is only as good as the data that we put in the first place. So if we can get access to more accurate, more granular data of the kind that Megan Green just mentioned, I think that will be very helpful to us.
Thank you. I think the committee's heard your plea for more access to commercial data.
Yeah. So, Claire Lombardelli, I mean, with all the work you're doing with Bernanke and changing the modelling, are you looking at other data sets? Is there any barrier to getting that information?
Yeah, I mean, we are obviously... When you take a step back, we're in a sort of very interesting time, I think, in the world of data. I mean, look, obviously the sort of gold standard is to have national statistics that are reliable, timely, and the ONS have a programme to get back to delivering that, and we fully support them and want that. We've, as both Megan and Alan have said, there's other sources of data that are really useful, and actually I think, in particular as we see technology change in this space, I think actually there's going to be a huge amount of data available. If you think about what AI is going to be able to deliver in terms of being able to access and also just draw insights from larger data sources, there's going to be much larger data sources and there's going to be more insight that can be drawn out of them more easily. We are thinking very carefully about how to do that as we implement the changes that we are doing anyway to the structures of how we do analysis through the Bernanke review. So in a sense, there's a real opportunity for us here to do them together, whereas in a lot of because we'll be making structural changes to the way in which we do our analysis as well, and our technology, and I've talked before and said before, a big part of the Bernanke review will actually be some of the kind of heavy lifting on the underlying platforms and how you manage data, how you manage information, how you run your modelling, all those sorts of things. So I think we've got a really good opportunity there to make sure that we sort of reform ourselves, that take advance of both these technological advances that will enable more data and better insights from the data, but also feed that straight through to our analysis. So, I mean, yes, and frankly, it's a great opportunity.
What powers do you have to acquire data? Because you can get obviously presumably any government data you can get.
Yeah, I mean, there are barriers that we face, particularly around where data. There's a lot of issue. Commercial data. Obviously, there's a set of sets of sort of restrictions around that. We don't own it. It is of value to people in the private sector. They might not want to give it to us. So there's questions, there's issues around that. There's obviously,
you say issues, you mean they won't give it to you, or you have to pay for it?
Yeah, there's a cost to the production of data is is a business, and there are lots of data is increasingly valuable in the economy. And actually, one of the things that happened fairly recently on GDP is the value of data was put into the economy, and you can see the value of that, and that will only increase over time, right? As we all see that just having more information. If you look at tech companies, and if you look at some of the investments in technology. For example, some banks are making, it's because they see the value of that data, right? The commercial value. We're a public sector organisation. There's limits to what we should be paying for data and what we can pay for data. We have to deliver value for money. So there's a set of issues around that. There's obviously a set of issues around sort of confidentiality and personalisation that need to be thought about. So Look, data isn't free. We have to navigate this well. It also, there comes a set of requirements. So we are thinking carefully about it, and we are looking at what are the ways we can get more data in a way. An awful lot of data out there that wouldn't be that useful, and you could spend hours looking at and trying to extract signals from what is noise. So we have to be quite, focused.
I think the things, obviously the data has to sort of evolve to reflect the way so-called intangibles in the economy. So these are things like data. These are the things that aren't sort of bricks and mortar and machinery. And capturing those properly. So the value of data, the value of IT, for instance, is important, because otherwise we end up, the economy is actually growing, but we're not capturing it. The second one is we saw this a little bit in the last inflation number, is what we call dynamic pricing. So you may have seen in the last inflation number, actually the number 3.8 was what we were expecting, so it wasn't a surprise to us. But if you looked at the services number, there was a big airfare component in there. Now, we've all had this experience. If you book a hotel, buy a airfare, book a concert ticket these days, you're subject to dynamic pricing. In other words, the price varies from hour to hour because that's the way they sell the things. And the question for us is that introducing more volatility?
And I was wondering if anyone on the panel could speak to the question of, are there precedents or things that forms of data sharing we could learn from other central banks or other national statistical bodies where there is access, and that the committee or the government should be looking at these precedents?
So it's definitely the case that other countries use admin data more than we do. And because they have built into their systems greater access to administration. Sort of privacy and data sharing. In some other countries, that is used more, across the public sector. Actually, I mean, the benefits. There would be benefits to us. There would also be huge benefits to other parts of the public sector, I think, if this information could be used. So that's one area that I would definitely say more could be done on. Other countries do also obviously think much more about some of these questions around dynamic pricing. You see a lot more of it in other countries actually as well. And particularly actually in some more emerging economies or economies that just use more technology in a lot of their pricing platforms. So there are differences, and we can learn from some other countries. Yeah.
Thank you very much. Chris Coughlin, MP.
Thank you, Chair. Governor, the OBR implies that stopping sales of QT, stopping QT could create 18 billion a year of extra fiscal headroom for the Chancellor and save us all significant taxes as taxpayers. Do you agree, and I understand that's outside the remit of the Bank of England in terms of considering fiscal issues, but you're about to set QT for the rest of the year. So would you consider suspending QT given current market conditions, given that I believe the ECB and the Fed have done?
Well, let me say 2 or 3 things on that. First of all, just to reassure you, the decision we're going to take in the next few weeks is an open decision. I want that to be very clear. Nothing closed about that decision. On the point about the cost of QT, I think I've made this point before, but I will make it again. I'm afraid I do have to push back on that point, because you either get the cost through the carry cost of the bonds, in other words, because the current the interest rate, the coupon of the bonds, the interest rate on the bonds is lower than the current official rate, or you get it on the discount of selling. And if markets are efficient, those 2 things equalise. Now, the cost can come through at different points in time, but they equalise over time. Over time, they equalise. So, just to be clear, there isn't a sort of pot of gold out there that isn't there if you do one thing, but is there if you do another thing. And I think that's just a very important point to bear in mind. The third point I'll make, I think I may have made this in the Lords before, but do not think that QT is the cause of this, by the way. There's a strong global element to it. What I would say, though, is that obviously in this open decision we're going to take, the interaction of that effect with our decision, yes, is something we will obviously look at very seriously. I've said that before, I'll say it again.
But would you agree? That's why I said the fiscal rules, in terms of if you suspended the sale now, that would create an extra 18 billion of headroom under the fiscal rules, and of course maybe that would come through later. I don't think the fiscal rules work that simply, but I'm not the expert on the fiscal rules. Okay. So because obviously the fiscal rules look over time, they're not a sort of snapshot in time thing.
Thank you very much, Mr. Coughlin. You and your
Thank you, Chair. Governor, in your recent monetary policy report, you have a section describing how bank staff have updated their analysis of the effects of QT on gilt yields, which thus impacts then, as my colleague Chris Coghlan mentioned, impacts the cost of borrowing and for the government. It just concerns me that your bank estimate now suggests that there'll be £16 billion in lifetime costs, which is a revised estimate, and you call that a modest increase. To my constituents, I think 16 billion would not be considered modest. It would fund, for example, an entire Elizabeth line, 40 new hospitals. This is a kind of quite large scale of government borrowing, I think, for any of our constituents to, government spending for any of our constituents to consider. So I wonder if you could just describe a bit the process behind the choice of that label, and also the updating of those estimates.
Well, our staff, as they do every year, as we sort of prepare for the decision we're going to take shortly, do what they think is an estimate of the impact of QT in terms of yields. And I think they've moved the range from 10 to 20 basis points to 15 to 25 basis points. So that's the change in their estimate of the range. These things are all, by the way, approximate, but that's their estimate. Now that is over the lifetime of the portfolio, which is a long-lived portfolio. I agree with you that number as a headline number is not a small number. I'm not in any sense going to dispute that number, but it comes from an estimate of a lifetime cost, and that lifetime is a long lifetime. The other thing I would say on that front, and we're working on this at the moment because it's in the letter that I wrote to Richard Tice that I copied to the committee, that there is another element to this which we're going to have a go at estimating because it is important. We're talking here not about the cost benefit of quantitative easing and quantitative tightening, because then you'd have to do a whole economy modelling exercise, and it's a very complicated exercise. This is about the cost of debt servicing, cost of gilts, as it were. And the numbers that get published through this are partial, and they're partial for the following reason: that the government got a benefit from QE programs because of the fact that they lowered the cost of debt, and they lowered the cost of debt issuance. And it was particularly important to the UK because the UK has been issuing much longer dated debt. Now, because that benefit then lasts for the life of that longer dated debt, and so that's an important thing to capture because that's a benefit that is in the cost of debt servicing. It's embedded in there. Now, to estimate that cost, of course, you have to do some sort of counterfactual exercise in which you say, what would it have been had that not happened? And we're working on that because I'm conscious that I think we've got a slightly one-sided view of the world at the moment in those debt servicing cost numbers.
I think we all understand that it's not in the power of the bank to travel back in time, or of this committee, and that's not the counterfactual I think I was trying to consider.
The benefits coming through now, I mean, it's going to be here now and for years to come, though.
The decision that the MPC are facing later this month is about active versus passive quantitative tightening, and the NBR piece that you linked to in that report suggests the costs of active QT as opposed to passive QT could be upwards of 60 billion a year, and I wouldn't choose the adjective modest for that. What would you choose to describe that?
No, look, as I said earlier, in an efficient market, these two things actually should be the same over time. So I really do push back on that number.
Okay. Well, can I thank you very much indeed. I mean, the issue of quantitative easing was a big discussion, quantitative tightening, a big discussion at the end of a hot afternoon. Perhaps not time to get into it in enormous detail, but it's something we will obviously return to because you've got your decision for a start coming up soon, and that will give us something to talk about next time we see you, Governor. But can I thank our witnesses for their time? We had a very interesting discussion. Particularly, we heard, of course, the Governor's concerns about the independence of the Federal Reserve, and I think we're grateful that we have an independent Bank of England, and we're here to challenge you, but that your independence is important. We discussed the three-way split on the MPC in its views on interest rates and how the Governor navigated that with the first time having a second round vote. We also discussed the significance of the rising 30-year gilt yield, of course, just now as included, and we explored the long-term outlook for interest rates, the impact of an ageing demography, and how international tariff developments are affecting the UK. So quite a wide-ranging session. As ever, we thank the Governor of the Bank of England, Andrew Bailey, Claire Lombardelli as Deputy Governor, Professor Alan Taylor, independent member of the MPC, and Megan Green, similarly an independent member. Can I thank you for your time? Order. Order.